We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. Reminder, as always, you can find our podcast on Spotify, Apple Podcasts, as well as Odyssey if you don't enjoy using YouTube. I hope you enjoy it and hope to see you on the next one.
Hey everyone, welcome to the space for today. Hey Bob, do you want to start us off here with a couple of topics? I know you had a couple of things that you wanted to start by going over today, and we'll put all the tweets and stuff in the nest.
Yeah, there's obviously a lot going on, and with everything that's happening in the metals, and I happen to take some time out basically over the weekend and kind of literally go through SLV. I read the authorized participant agreement, as well as I think it's the custodial trustee agreement as well, to kind of just get a real understanding of, or depository trust agreement, a good understanding of what actually happens and goes on, because there's so much confusion with the ETFs and so forth, and how they operate, the authorized participants, how they make money, how the custodians involved, the trustees involved. It's just I figured let's walk through it, sort of together, and that way it'll help explain to people, how this thing actually operates, how SLV operates, how they influence the market, how they influence SLV, and how they basically make money off of managing that SLV. It's really more like a proprietary type of product, and it's almost a structured program within itself for the authorized participants to gain from. So it's important to kind of understand that, because that's all part of this. My theme is that these paper products are all sponges of basically taking money that would maybe otherwise go to physical metals and having it go into these paper forms that only increase risk. It doesn't take away from risk. And in this day and age, what we're looking at in the markets and so forth is trying to reduce risk, especially counterparty risk and systemic risk, in the face of, now these central banks are trying to tighten and create demand destruction and bring down sort of the financial markets, to bring down the wealth effect, to hopefully bring down inflation. But what they're actually doing, I don't think they realize the second tier effect of basically people start losing their jobs, is you're going to piss off a lot of people, and crime will go up, and you'll see the other end of this that could be rather devastating for many people. So it's trying to educate them so that if they want to make that choice to go into the metals, how to do it best for themselves, not necessarily for the program or the person selling that metal to them. Really look out for their own interests.
So maybe why don't we start by talking a little bit about maybe the differences between SLV and PSLV, Bob?
Yeah, and I could kind of start, and keep this, on a sort of simple basis as much as possible. And then we can get into the details of PSLV and how that sort of operates, and compare that to SLV and how that operates. With SLV, it's an ETF, not an ETN. ETNs are exchange traded notes. They're debt instruments, even though they trade similarly to the way the ETF trades. It's more of a liability of the sponsor or the bank, whoever's underwriting that or issuing that security. So with SLV, how ETFs work is basically on the premise that the authorized participant can create and redeem shares. It's the idea that ETFs are designed to try to keep their net asset value as close. The intraday trading or market prices of the ETF are as close as possible to the actual underlying net asset value of that fund, if that makes sense. So you're always trying to trade really a the representation of, for example, SLV silver, you're trying to say, listen, I'm trading a liquid instrument that I can move a lot of money through, but I can do it in a way that it's trying to stay as close to the silver price as possible. And it's this creation and redemption process is what actually gives ETFs the advantage, I think, over, like, for example, closed-end funds, in that the authorized participant basically delivers the underlying security or asset, in this case, silver, to the ETF or to the trustee. The trustee doesn't take in any money. They don't have to go out and buy the silver, take delivery of the silver. It's really up to the authorized participant, because the authorized participant's incentivized to add shares into the market when the fund's at a premium. They basically sell. There's a profit arbitrage, or it's not a risk-free arbitrage, but there's a risk arbitrage involved where the authorized participant can sell the ETF on a cross basis. For instance, if the fund's trading at a discount, for example, to NAV, they can actually buy shares at artificial discount, turn in those shares, redeem them for the actual silver at a higher price. So there's some arbitrage that starts to play into that. And that's where the authorized participants can gain some advantage and profitability. So just like, and it may get complicated here, but when SLV is trading at a premium, the authorized participant will actually create shares, sell them into the market to try and bring down that premium closer to NAV, while at the same time, they actually may be buying the underlying silver to try and raise the net asset value. So it's important to note that the ETF itself doesn't do any buying and selling of underlying. All they're doing is exchanging shares and the underlying instrument the fund's invested in. The idea that if you get a short squeeze, it could impact the market price relative to the net asset value. But in reality, if you got a squeeze going, it could actually incentivize the authorized participants to create even more shares to sell it at a greater profit if it's at a higher premium, and then actually buy the underlying silver. When they sell shares, they have to deliver, basically when they create shares, they have to deliver the actual underlying to the SLV in exchange for those shares. So it may get confusing, but there are some safeguards, and there's a lot of agreements that I've read that basically says that SLV has to have the metal in its account before it can issue the shares to the authorized participant who has created those shares. Basically, when they issue those shares, it's basically a DTC type of transaction where they go to the Depository Trust Corporation, and basically the shares go under the registered under the name of the authorized participant, for example. So there's that exchange that goes on, or recognition that goes on. But the fund itself actually doesn't do any buying and selling, if that kind of helps a little bit.
Yeah, so you're saying that it's basically separated into two parts, right? Being the participant, and then what was the other word? The fund itself, and then the authorized participant?
Yeah, basically the parties in an ETF is the sponsor, the trustee, the depository, or and then the authorized participant. So each has a separate function. So with SLV, for example, you have the depository, who's typically a bank that custodians or you can call them the custodian or depository, but they hold the metal. They have the trustee, who basically runs the day-to-day operations, the sponsor who's created the whole idea. And then you have the authorized participants, who are hired basically or contracted to provide the liquidity for that fund to operate. And in exchange for providing that liquidity, they're giving the exclusivity, I guess you could call it, to basically buy and sell or create and redeem shares and be able to capitalize on the arbitrage that's created from that creation and redemption process. In reality, Wall Street created a product that tries to mimic an underlying asset And you see this like with the spiders, for example. S&P 500, it has 500 different stocks in it. It's very difficult for all of us to go out and buy 500 different stocks all at one time. So it's easier just to have an authorized participant be involved in that process and buy all these shares and put them into a basket, for example, and deliver and create or redeem that basket. So it's easier for us as an investor to participate in just, if I want to buy the S&P 500, I can do it through an ETF. There's reasons to actually, there's some advantages to it. And it's grown in popularity. The ETF market is enormous. It's had its people that have been for and against the ETFs in terms of the market dominance that the ETFs have created, the passive investing that has gone in with ETFs, because they're used by traders, but they're also used by investors. So they can get specific types of allocations at different types of strategies, that type of thing. But it's interesting to note that basically when we had the flash crash in I think it was 2010, it was the ETFs that got hammered. The ETFs represented 70% of the securities for which trades were canceled by exchanges, in which prices dropped 60% or more. So a lot of the ETFs underperformed their underlying by as much as 60%. And that's one of the downsides to these ETFs, because they react so fast and there is risk involved with them.
And that's is that because everybody is trying to get out at the same time?
Yeah, and you saw it with March of 2020. March 2020, you had people selling, you had margin calls, and so what happened was you had an accelerated move on a derivative, an ETF that basically holds the underlying, but even that derivative or ETF actually starts selling even faster than the underlying, and because it's its own security to begin with anyway. So you have this sort of magnified effect that can happen in the markets. And that's where a lot of people get concerned over the enormous size of these ETFs, because all it takes is, some of these ETFs to start seeing some high level liquidation. And not only does it affect that ETF, it affects it affects the underlying that ETFs invest in, because then the authorized participants may have to go in and massage or try to arbitrage or support the ETF, or there may be redemptions where the shares are being canceled and they're taking delivery of whatever the underlying is, and then they have the underlying which they may have already sold or hedged in the market, so that delivery may be already netted. I mean, there's so many different things that go on. And I think that's what makes it really confusing to the average investor in the physical world, and especially in the precious metals, is that SLV has a lot of impact, I think, along with other ones out there, that has these second tier type of effects that can influence or have an impact in the marketplace. And just like, for example, when you have SLV trading at a discount, for example, to its net asset value, and the authorized participants want to buy those shares at that discount to help support that ETF, they may go in and sell the underlying to try and drive that price down as they're trying to buy the NAV or the ETF shares, trying to bid them up. So they bring the NAV, the intraday NAV value, and the share price back to equilibrium. So that's sort of the dynamics of how these things work.
Bob, so is there something in your homework that you're doing that the authorized participants, just like what you just mentioned where they might be looking to sell the underlying and then to try to bid up the NAV, okay? All right, can you see a way, Bob, that would be causing some sort of manipulation where they're causing a sell-off in the underlying and then they're trying to buy the asset at a discounted net asset value for them to benefit their own account versus benefiting the SLV account? Is that possible?
Yeah, I mean, that's a good question. Manipulation may not be the correct word. Influence may be a better word, because really, in essence, they're working for their own profit motive. I mean, they're not sort of trying to, with malintent, trying to hammer the silver price, for example, for some type of gain. They're just trying to use They're tools that they have to actually profit from the different arbitrage that goes on. So for example, the authorized participant, they may go into the futures market and use the futures market as a hedge against whatever their physical trade is in correlation with whatever they're doing with the as an authorized participant in the ETF. So if they're creating shares, for example, they have to deliver metal to the SLV. So they may be, that metal may be something that they're buying on the open market. They may actually just have it in inventory, and therefore they're just giving their inventory, and then they may go into the futures market somehow, or they may go into an OTC transaction and buy more silver, or go into the futures market, maybe buy futures contracts to replicate what they just gave away out of their inventory. I mean, there's so many different ways to look at this that has impacts on the overall market, that I think when we start looking at it from a standpoint of, you see 5 million ounces, like for example, today didn't make any sense. The only time silver can leave SLV is if shares are redeemed, and the shares actually have to be redeemed first, and they have to be good delivery shares, no encumbrances, that type of thing. And then once those shares are moved over by DTC, then the silver gets released. So to see what happened today, unless there's a delay somehow, but usually what will happen is the silver will leave as the shares are reduced. Just like when you see the opposite happen, where if we go to a premium on the SLV and shares are sold by Created, for example, what'll happen there is they have to deliver silver to the fund for an exchange for those shares, and then they of course they've already pre-sold these shares into the market, so the delivery of that silver comes in by the next morning, but you have that increase in number of shares. But they move the silver through the channel of the custodian, and this is where it gets kind of interesting, and this is where I think it can get kind of confusing. The authorized participant has to open up an account with the custodian, typically with the custodian that SLV uses. So they open up an unallocated account. They move metal into the unallocated account. It then is, as the process of going to the ETF, it's then basically signed over to the ETFs, or the instructions are given. So the custodian bank then holds that in their name or holds it in the account of the ETF in an unallocated form. And then at some point, it's then, say the next morning, it's then broken back into an allocated account, and specific bar numbers and serial numbers, that type of thing, are then recorded. But there is that chain that moves through an unallocated account. And that's a weak link right there. That's basically, if the bank went under, for example, and they're the custodian, that metal is trapped in an unallocated account at that moment in time. There's potential issues that could arise. That's one issue that I see with the ETF. So people that are buying SLV with the idea of saying, hey, listen, if everything goes to hell in a handbasket and I just want to diversify and buy some silver and have it in an ETF, for example, and think that I have some exposure or some representation, you could actually have exposure and not representation. But that's just one element. How the authorized participant gets the metal, that's another issue in terms of when they deliver that metal into their unallocated account. It could be from their own inventory. They could be buying it on the open market. They could be doing swaps. They could be doing, where it gets kind of interesting, is repo and borrowing or loans. With repo and loans under English law, the borrower actually retains title to the metal during the period of which the borrowing's taken place, and then there's an agreement that says, okay, I have to return said metal or similar metal back to the lender plus interest. There's many different ways an authorized participant could work. An authorized participant can go onto the futures market and hedge. For example, metal that they have in inventory, they may use the futures markets to hedge and sell that against that underlying inventory, so they have a price neutral type of strategy, so they don't have downside risk or they don't have upside risk on the metal. And you got to remember, these authorized participants, they're typically broker dealers, they're all DTC participants, so they're going to be the Goldman Sachs, the big names in the business, because they have the the balance sheet to basically create or provide the liquidity that's needed on a day-to-day basis. That's some of the inner workings with authorized participants and the ETFs. And it's partly, some of the stuff is just a lot of trading that goes on, but it's trading that's based on spreads, not necessarily based on manipulation or malintent. It's, it has an impact on the market, but its impact on the from the authorized participant standpoint is to try and buy in one market, sell in the other, and pocket that small difference in price.
So Bob, at any point does it make sense for your average investor to buy into any of these ETFs rather than buying physical metal?
If you're a trader, the ETFs work really well for people that like to trade, because the advantage that the ETFs have is, by design or the nature of them, the deeper the market, so to speak, or the broader the market is, more money can kind of flow, and there's this sort of illusion of liquidity with the ETFs that you may not be able to get with the underlying asset. So for traders, they really like the ETFs. SLV, GLD are very popular because they stay near their net asset value. So there's some dependability from the trader's perspective that they don't have the risk of premium and discount disparities that you may have, maybe say with, an ETF with Russian securities, for example. I mean, as an example, you get into a market that's very illiquid, that could have very wide spreads, and prices move on a dime in very large directions in either way. It makes it much more difficult for a trader to anticipate that. So it has advantages for the one who wants to trade. For what we're going through in this marketplace, and what I've been seeing for the last few years, is this deleveraging that you're having. It's creating more and more volatility. And as that volatility continues to grow, counterparty risk starts to increase. You see it with credit default swaps everywhere. Systemic risk starts to build in the system. And the whole reason to have physical metals held directly, whether in your person or at home or in a trusted depository, in that type of fashion, is to protect you from the risks that paper investments cannot protect you from. It's very difficult to diversify away from ultimate systemic risk in an ETF, because there's a number of things that could go wrong there, that you could have a breakdown. And you got to remember, the shares in the ETFs are all under the name of seed and company. So the way they're designed, like SLV, for example, everything is under the name of one entity. And that entity, the reason why the DTC does that is that they can transfer and exchange these shares amongst buyers and sellers much easier, just having it all legally under one name. Even though when you have it in your brokerage account, you're a beneficial owner of the security, meaning you can get the dividends or the stock split, that type of thing that you're entitled to, but you actually technically don't own anything, which is kind of surprising. But that's partly why I think the allure of maybe cryptos kind of got a lot of people fired up and energized, was that at least I own the keys, so to speak. So there's a degree of control there. And that's one of the reasons why physical owners like myself that am running a depository, that's the whole basis for owning physical metal, is that it's an asset that doesn't have any type of, no one else has promised to pay. And that's part of the allure. And again, also the idea that you're dealing with private property. You're not dealing with a security or a fund that requires some type of settlement procedure. That metal is yours. No one can take it away from you, except maybe the government, I guess, but or somebody that has malintent, I guess. But it's designed to provide that degree of certainty for you.
And Tom, one other thing that, if you want to think about it this way, the rationale for having these ETFs, these paper products, might have been, well, if we don't offer something to our customers might withdraw 20%, let's say, of their $100,000 portfolio and buy Silver Eagles or buy Gold Eagles or something with it rather than SLV or GLD. So it was a way for them to keep, they meaning these big banks, it was a way that have brokerage offices. It was a way for them to kind of keep the funds captive so they could earn management fees. That's a possible answer.
Mm-hmm. Kind of put it a bit more simply, Bob, for the average person, it doesn't really make any sense to have exposure to the ETFs versus physical metal.
If your intent is to trade the markets, the ETFs are a vehicle to do that. I mean, if you're knowledgeable and
basically that's
if you're trading. Yeah, because for some people, if they're dollar cost averaging and they're just trying to get price representation, their intent is never to actually own the physical. They don't want to be bothered with the physical. They just want price representation. That's what the ETFs, that's a tool that you can certainly use. I definitely would read all the disclosures and risk documents and that type of thing. But yeah, it's designed to be a very convenient way to get representation of the move of the metals. And that's where I think investment advisors, I've been an investment advisor since 1992. And I go to a lot of investment advisors and I try to explain to them the reasons to own physical versus paper. And the investment advisory practice has a very difficult time with the physical asset, not just because it's a physical asset and maybe us physical metal owners are all crazy. No, the reason why they have a problem with it is they can't charge a management fee on a physical asset. They can only charge a management fee on a security or fund. And so it makes it more difficult for them to participate in the physical world. And so it's sort of against, in a way, a little bit against their interests. And it's unfortunate. So what Wall Street tries to do is they create these products that says, okay, if your client has interest in it, we got a solution for you. Or even worse, we have a structured product, which we've gone over a few times on spaces where they get really creative. Mm-hmm. But that's part of that sponge effect that's really drawing money that would maybe otherwise go to precious metals and siphoning it off and going back into the paper markets. One of the reasons why I'm so adamant on the premium structure, what dealers have been charging, especially the last couple of years, I'm all for people making money. No question about that. It's great to see dealers make money. The problem is, when I see what their markup is compared to what the asset has to offer, it makes it much more difficult for the public to understand, how do I actually make money by buying something at a 30 or 40% premium? They don't understand maybe the dynamics that, hey, listen, the bid price could actually go up on that product, not just simply just go at spot. It's that dynamic to maybe get more participation from the public by trying to keep the premiums down. And this is something that, I've talked with wholesalers on ad nauseum, and I've seen retail dealers. I know what retail dealers are buying the products for. It's and they have every right to make money, and that's great. But the question is, are you going to get a broader audience by milking that last cent per ounce out of that client? To me, it makes no sense, because I look at this from a fiduciary responsibility or an investment advisory type of concept versus a dealer transactional based concept. So, with the dealer side, hey, their job is to move metal. They get paid on the transactions, similar to what Wall Street does. But I look at it, really from the client's perspective and says, hey, listen, how much of the price move do I have to make back up in order to make any money in this thing? And that's something that when we were at $26 silver and you saw some of these outlandish premiums that were going on, those people are now they're paying the price a little bit for it, because now with the price coming down to where it is, they literally have to make almost 100% return to break even on some of these products. And then you have, not to mention, products or companies out there that have charged 50 and 100% premiums on these fractional 1 ounce, 1.25 ounce, 2.5 ounce type products. I mean, you see a lot of these infomercials and late night TV ads, and that just suck people in as well. I mean, those things don't do it justice for the industry, but it happens. And that's where, again, I'm trying to help promote education get people more interested in the actual metal itself, try to bring down that premium structure so they feel like they have the opportunity to not only participate, but also to make money, because the metals offer a lot of value, especially in this type of time frame. It may not be the greatest time to buy metals all the time, but when you're heavily indebted, and eventually, like we're seeing with a lot of these countries, they're starting to do yield curve control and support their markets. Otherwise, they're looking at pension collapses and probably other counterparty risk measures that are just going to fall like dominoes. The same thing is going to come to our shores at some point. The scary part is that we're watching the world kind of burn financially. Who's going to support the treasury market when it's our turn to go through that whole cycle? And that's a scary thing. And that's where I think one of the reasons why I run a hedge fund is that it's the idea of trying to learn about the markets, manage those expectations, and try to position assets for the longer term. Hopefully that gives a little bit of insight.
Mm-hmm. I see that Steve has graciously joined us here. Steve, is there anything in what Bob said that you want to add to?
I definitely agree with Bob. I mean, not to give any names out, but I looked at one of the websites, one of the dealers. They're charging 86% premium on a 1/10 ounce gold eagle. You pay $320 for a 1/10 ounce gold eagle. And what's the spot price? About $1, 172 or what? I don't know what it is. And so you're paying that much of a premium. I mean, that's insane. So I do agree. Unfortunately, I missed the first half hour of what was said, but I do think, and one of the things I want to say that's important, there are two different markets, and I hear a lot. I heard someone in the precious metal industry say, well, if you get the SLV, you don't own the metal. Well, if you go on vacation for a month and you rent a vacation house, you don't own the vacation house. You're renting it for a reason. You don't need to buy it and hold it and say, oh, I have this. You're renting it. And so what happens with institutions, they're not really interested in owning silver. I think they should, especially as the time goes on, they should own their own metal. But what they really want to do, large investors, hedge funds, they want to get exposure to the movement in the silver price. It's the same thing with going on vacation. You want to get exposure to some relaxation. You don't want to buy the damn place. You just want to rent it for a month or a month and a half. And so I think we need to understand there's two different markets. There is a retail bullion market, and there's a whole different market that's for the larger players. And even though Bob has brought up a lot of these very interesting products, these structured notes, these buffered, all these different notes and the issues with owning the ETFs, unfortunately, they're going to continue to do that. And one last thing on the same lines, as I mentioned this in one of my updates, Tom, is that there's twice as much silver in the silver ETFs that's being traded than it's on the LBMA registered in Shanghai. It's like 670 million ounces on the ETFs that are traded. I'm not including Sprott, and about 360 million ounces on the LBMA other, and that's the registered, and also the Shanghai. So you've got twice as much silver on these ETFs. And I think Chris Marcus, he did an interesting interview with Vince Lanci, talking about the crazy dynamics, the way the silver price is moving around. And I think what happens, you get some big funds just getting out of silver, and they sell out, and they're moving out. But it may take a couple of weeks for the spot price to actually move into the direction that is being dictated by the large funds moving in and out of these ETFs. So I think it's a very interesting dynamic, but that's what I wanted to add to that discussion.
Perfect. Thanks, Steve.
If I could add something to that, what's interesting with the ETFs, the way the structure of the market is, how stocks are held in street name and transferred then DTC and so forth. There isn't, when, for example, let's just say brokerage firm A is an authorized participant, and they deliver metal, they take shares from the ETF, they create those shares, they may hold it in their name. It's very difficult to distinguish who actually owns those shares under brokerage firm A. It could be their proprietary desk, it could be their trading desk, it could be individual investors that they're custodying those assets for. That's one of the problems that we have, is the transparency side of actually who actually owns those shares. Yes, it's held at brokerage firm A, but you don't really know within that brokerage firm who's doing it. So a lot of these authorized participants may have actually big positions in these ETFs because they use them as inventory. And you've seen that with banks getting out of the commodity business. They've moved some of these commodities into these ETFs because it's just easier. It's more lucrative maybe to trade an ETF because you could also lend those shares out and derive an income off of loaning those shares to short sellers, for example. So that's another thing that, oddly enough, the market is actually, that adds more complexity because now you're dealing with this big short position that you had built up on SLV, for example. And Steve was mentioning before we got on that about 10 million shares have came out of that short position. So about 49 million shares that was reported about as of a couple of weeks ago. And a lot of that 10 million came out before the big move, the big pop happened. So you don't know if those 10 million shares were market makers or if it was speculators or just other types of participants.
Bob and Steve, I got a question here. How about ETF as portfolio insurance in retirement accounts? What do you think about that? I mean, like you were saying, if you're trying to purchase, let's say, insurance, in some ways you want the metal, do you not?
I think what you want to do is you want to look at ETFs that do securities lending and just go all in. No, I'm just kidding. Yeah, there's so much, to get more leverage for your bang for your buck in a rising interest rate environment. Yeah, that sounds like fun. The idea of insurance, yes, they do have inverse into ETFs that you can buy that acts inversely with the move of the markets. It may give you some of that protection, but I think it's also important to understand the dynamics of how those things work, especially the leveraged ETFs on a longer term basis are the worst things to own because they have a decay built into them, a rolling factor and so forth. So if you're using like the leveraged 2 or 3 time ETF, you're literally wanting just to trade that from day to day because it's going to have a constant dilutive effect just on the volatility and how.
I think he was speaking specifically about, let's say, PSLV or SLV rather than any leveraged product or anything like that. Like if you would actually purchase an ETF, let's say PSLV and or SLV as portfolio insurance in a retirement account.
So basically you're saying at least it's silver, that the ETF has the silver. So if something really bad happens, there's something there that it has value behind it. Is that kind of what you're thinking?
Like I know that there's a difference between being able to actually be somebody that is allowed to redeem metal hopefully at some point in that case. But his question was specifically about ETFs as portfolio insurance in retirement accounts. So let's say buying PSLV as part of a retirement account.
Well, there are ETFs out there. I mean, there's a lot of them. And there's some ETFs that are popular that people will use. They hold the metal in Switzerland or some other place. And, there may be some distinguishing factors between these ETFs. But the ETFs themselves are relatively all the same in way they function in terms that the shares when they're redeemed and silver's taken out, there's a process between that needs the system to be completely 100% in place. Otherwise, you have dislocations. There's risks that are involved, and those risks are actually described in the prospectus and that type of thing. And so from that perspective, if you really want to get into portfolio insurance and you're thinking, okay, we're going to have, the UK pension system is going to fail. What's that going to look like to everything once prices start to, free fall, and the Fed says, they finally kick in the gear, but it's too late. And, you have this, massive meltdown or whatever it may be, and people lose confidence. In that role, until the dust settles, you may be in a situation where the market may simply just shut down. And so you can't even access your brokerage account. You can't sell those shares in the market. Now, some programs offer the idea of direct redemption, or the ability to, maybe with ETFs, you have to go through an authorized participant. So you may have to go through your brokerage firm if they're an authorized participant and try to have them take that metal delivery for you if they're willing to do so. But it's up to them to do that. With PSLV, there's a process to simply take delivery. You have to provide notice the 15th of the month, and then you have to wait till the following 15th of the month to get the metal. And there's some fees that are built into that, 2% redemption, up to 2% redemption fee, I think, with the Royal Canadian Mint. But you also have all that metal stored at the Royal Canadian Mint, which is a crown corporation in and of itself. So if they decide one day to privatize the mint, the Canadian government, what happens to all the assets? Maybe that was a question that was tinfoil hat thinking 3 years ago, but ask anyone who assisted the truck drivers. That becomes a totally different story there. So anything can happen. So, and then also you have the COVID situation, getting over through the border, going to, you'd have to probably find some type of outfit or logistics company to go pick up the metal at the Royal Canadian Mint. And there's some nuances there that, if you're a U.S. citizen, if you go through that redemption process and it's not in an IRA account, and let's say you want to redeem for that silver, that's a taxable event at that point. So that's an additional cost there. There's a lot of extenuating circumstances that are wrapped around it. And then you get into, and I'm not even getting into, share dilution, trading costs, fees, et cetera, that are born in both ETFs and closed-end funds like PSLV. But PSLV has, I'm sorry, Steve did an interesting chart with how dilutive these funds can be over time. Yes, these funds can be dilutive over time. And one of the things I've been saying the last year or so is with PSLV, and when they were doing all these at-the-market offerings, I said, these are dilutive share offerings, especially when the fund is trading at a discount to NAV on a day-to-day basis. The only way PSLV can actually do one of these at-the-market offerings, buy more silver, is when the market rallies big and the price of the shares go above the previous day's NAV closing price. Then they can affect an at-the-market offering. And what happens is the fund gets the money based on the NAV of the prior day. So they get funds at yesterday's price, but now you have a higher silver price today. So it's very common to see this like clockwork. When you see a big share offering with PSLV, you can almost guarantee that in the next couple of days, the price is going to get crushed, because that's the only way that PSLV can actually buy the metals and try and reduce that dilution. And that's something I try to explain to people. And you get a lot of feedback from that. I mean, it's, especially from people that are kind of loyal to PSLV. And I get it. There's some advantages to PSLV. It definitely lowers trading costs if you're just buying and selling, and you don't have to deal with the spreads of physical products and that type of thing. There's advantages that way. But I think people need to be aware that there's also a dilutive factor. If they continue to do the at-the-market offerings, that can have an impact. That's an additional cost.
Tom, can I give a stab at answering your question on the portfolio insurance?
Yep.
Okay. Evidently, it's one of your viewers or listeners that asked the question. It's very simple to just try and find an index that mirrors the portfolio that the person has the investment, and simply buy a put option. You can buy as much time as you want. You can buy a 3-month put, 6-month put, a 1-year put, whatever you'd like. And that leaves your upside open. If the index or if the portfolio continues to go up, you didn't need the insurance. If the portfolio goes lower, then the put increases in value to offset that. And it's easy to load that number of puts that you need by how much investment you have in the index that's going to mirror the portfolio. The other thing is, in answer to the question you're asking, is that if you just review the performance of the high of the year on the SLV versus the current, the Dow Jones is down about 22%. The SLV off its highs is down 30%. So I would wager to offer this, that the SLV did not work as portfolio insurance. If that's the index, if that's one of the ETFs that your viewer is asking about, the metals didn't protect the general equities portfolio. A put option would have done that.
Mm-hmm.
I think it's interesting to note, though, certain products within the precious metals have actually done fairly decently because of the premiums going up. It may not have been the metallic content of the coin itself, but even though Eagle prices are crazy, wholesalers are buying them back at $8, $9, $10 over spot or whatever the price that they're buying back at. So you do have. That's one of the reasons why physical metal is kind of an interesting asset class, because there is supply and demand constraints where in reality, an ETF can create shares as long as they can deliver silver. They can create, I don't say unlimited amount of shares, but they can. The authorized participant, there's nothing that stops them from obtaining the metal to potentially delivering that metal to make an arbitrage profit off of creating shares. There's an incentive for them actually to take that risk. And so not understanding or not the transparency is not there on how these authorized participants acquire the metal or hold the metal in inventory, or if they're using the mining flow activity as sort of like a balance sheet financing operation where they're basically using metal that they would maybe get from the mining activity, having that refined and then delivering that to SLV, but then using arbitrage plays to profit around that. I think it's important to understand, though, that the SLV itself may not promote the metals markets the way the physical market would actually promote it. It's more of a trader's market than it is really an investor's market.
Gotcha. Happy you had your hand up here for a bit. Welcome, man.
Hey, yeah. So I own physical as well as PSLV, and I am one of the people who tends to recommend PSLV to people. And one reason for that is there's a lot of smaller investors online, on Reddit or Twitter or really anywhere who are always asking for a recommendation of where to put money from like their Robinhood or Webull account or just whatever brokers they're with. And it's a couple $1,000s, even a couple $100s. And they have no interest in physical metals whatsoever. And so for them, I do tend to recommend PSLV. I think there's a fairly simple equation in terms of if you plan to hold metals for a very long time, say even a decade or more, I think physical, even at relatively high premiums, can make quite a lot of sense, especially if you're storing it yourself. Whereas the ETFs, whether it's SLV, which I don't really like, or PSLV, which I personally hold, you get to skip the upfront premium. For the most part, PSLV occasionally trades at a premium. It's typically at a slight discount to NAV. And then you get charged essentially an annual fee for holding that metal. So the longer you hold over time, the more of a disadvantage it is to own something like an ETF versus the physical. So I think it's just there's a math debate here in terms of which is the best for returns. I think that's a lot more clear. And then I think Bob typically likes to talk about a lot of the, say, like legal or more extreme tail event risk, which, I agree with. if society is melting down or the financial markets are truly collapsing, and you really have to look at counterparty risk and all a variety of other risks that typically you don't have to think about. Self-custody or a depository like his, those things start to get more important. So, I think if you're just looking at portfolio returns, that's a much easier debate to have. And I think PSLV does a good job of giving you exposure to silver. That is real, that they purchase out of the market and ship to their vaults. But if you're going to hold for decades and let your kids inherit it, I highly recommend physical. And if you're going to buy quite a lot of silver and don't want to store it yourself, then I highly recommend Bob's service as well. So that's all I have to say.
Thanks for your input, Happy. I appreciate that. And I think that's a good way to put it. Again, if you only have a couple $100, that premium becomes really, really important to think about. But I want to get you to weigh in on why you choose, let's say, PSLV versus SLV, if you wouldn't mind.
Yeah, sure. So I guess this goes back to the good old silver squeeze, which had lots of drama. But originally, I was just buying SLV like most people. It was the largest and most liquid silver ETF. It still is. And during the week of the silver squeeze, a lot of sketchy things happened with that ETF. They might run out of silver to acquire, and thus might have to shut down new creation of shares in the ETF, which was pretty ironic to see the world's largest silver ETF, which stores all of its metal, most of its metal at the LBMA, has direct access to metal there, saying that if demand persists like it did during that week, that they were going to run out of metal to be able to buy. When you had people like Jeff Curry that same week being interviewed saying that there's essentially an unlimited amount of silver available, that there's something like $50 billion. I can't remember the exact number he said. It was some like 20x multiple of the amount of silver that is at the LBMA is available. Yet you had the world's largest silver ETF saying that they're about to run out of metal to be able to source, which didn't sit well with me. I think price should solve everything. So if they receive inflows, they should keep bidding up the price of silver to be able to get more silver to be able to fulfill those inflows into their ETF and create new shares. So my theory is that, and this is just my theory, the custodians have like a set amount of silver that they bought and trade back and forth with SLV that they're willing to allocate to the fund. But once that pile of silver runs out, they are not willing to go into the open market and purchase more silver and push up the price of silver from that demand, which is a very strange thing if you think about that dynamic compared to other ETFs or other markets. When people buy a stock, they're directly putting a bid under the price of that stock and potentially pushing it higher. Or if you go buy, say, the USO oil ETF, as inflows go into that fund, they're directly purchasing futures. And inflows into USO could theoretically drive up the price of oil because they're having to purchase more oil futures contracts. But with SLV, there's no direct connection whatsoever to the market that sets the price, which is the futures market. So when inflows happen to SLV, the ownership allocation of bars that already exist in the custodian's pile will shift back and forth, but they are not willing to go out and source other bars out of the open market like PSLV does, and nor do they purchase futures contracts. So if a lot of retail investors all of a sudden pile into SLV, it will do absolutely nothing to push the price of silver higher. And just from some cursory analysis I've done, there's actually, from what I can tell, a slight negative correlation of inflows to SLV and the silver price. So there's either no correlation or, a slightly negative one, which is very strange to me because you would think when people are highly demanding something and purchasing more of it, that would send the price higher. Whereas when I did that same analysis on PSLV, there was actually a very strong positive correlation. So, and I think that's because they do go out and take bars out of the market and out of the spot market, put them into their vaults, which creates a tighter physical environment. So that's why I like PSLV. I do know that SLV has a slightly lower management fee. And to Bob's point, there is dilution with PSLV, so which I think partially does prove that there is a more real aspect to PSLV versus SLV, because the dilution comes from, their expenses of acquiring that metal. So purchasing it through a broker, issuing the shares, and shipping the metal to their vaults, which moving a real asset has real costs. So as they add metal to their fund, it's essentially an expense on the current investors. The fund has grown quite dramatically. In the summer of 2020, the fund had roughly 50 million ounces. And in, I think the latest, they're up to about 165 million. So the fund has more than tripled in size. And for my calculations, for every 1 percentage point that PSLV expands, the current investors essentially lose between 1 and 2 basis points of their investment due to that dilutive effect. So really, you've got like a 0.6% management fee plus 1 to 2 basis points for every 1 percentage point that the fund expands. And this is an important thing. I think it's somewhat tough for people to understand sometimes, but as the fund gets larger, the future dilutive effects shrink, because it's much harder to, say, double from 165 million ounces to 330 million ounces than it was to double from 50 to 100, because there is just a limit on how much silver there is in the world to be added to the fund. So essentially the peak holding cost over a 12-month period was going from that 50 million up to, I think it was like 138 million a year later. And if you held from 50 million to 138 million, you were essentially charged 2.5% for holding that fund over the course of a year versus the long run average closer to 0.7%. But for that to happen again, for someone to be charged, say, 2.5%, PSLV would have to balloon over 12 months from 165 million ounces to closer to 500 million ounces over 12 months, which probably isn't even possible given how tight physical is, unless, say, SLV just collapsed or something like that. If you're doing the math on your own, you can try to guess how much PSLV will expand. That is an argument in favor of other methods. It's not in your control how much PSLV expands, but you'll lose 1 to 2 basis points for every 1% it expands. So you do 1.01 10 times, and it's grown 11%. You probably lost 10 basis points as it grew 11%. There's kind of a weird exponential thing to this. And I know I'm been talking for a long time. I want to let other people respond. But I prefer PSLV because I think it is real. I think it does actually impact the silver market much more than SLV does. And if you are a large investor, the redemption on PSLV is 10,000 ounces versus SLV is 50,000 ounces. So that's another advantage.
Gotcha. Thanks for your input there, Happy.
I'll clarify a little bit. And I appreciate Happy for getting on. I respect your viewpoint on PSLV. What's interesting with PSLV, which makes it different than SLV, is there's an incentive by the way the structure that the at-the-market offering works is the sales agent is paid a fee for basically selling those shares into the market. PSLV would create the shares, or has already registered shares. So when they get an opportunity, they can sell those shares into the market. And if there's a big influx of orders, they can sell new shares into the market, and that's how they actually are able to start buying more metal. There's a couple of interesting notes. With that, how that works, again, you have to have the fund has to be trading at or above net asset value when that transaction takes place. How they are able to do this when the fund is trading on a day-to-day basis at a discount, and it trades at between a 2 and 3% discount most of the time, maybe 1.5 to 4, depending on the swings of the market. They need a surge in price in order to affect that trade. And subsequently, they will add ounces into the fund on a price drop, and that's how they are able to remove some of that dilution. That also helps with their trading costs as well, because they take the metal in as of a certain day, price pulls back. It helps with the logistics as well as premium on the bars that they're buying. What the part that I have the issue with is the way that the Wall Street silver movement and others will portray PSLV as this is going to be the fund that breaks the market. It can't break the market because of the way it's structured, meaning if it's trading at a discount, it needs that surge in price to issue more shares. It can't go around right away and buy the silver at that moment, because otherwise the silver will be at a higher price than what the fund's receiving the funds at NAV the prior day. So it'll actually be even more dilutive. And so that's why, and then on top of that, when they issue more shares, that means there's more shares outstanding. That means it's, the fund has, especially in a time of crisis or volatility, I should say, the fund can go, you can have more shares in shareholders' hands that may sell. They may just panic or get out, and that fund can go to a deeper discount to NAV than what maybe other ETFs would maybe do, because you have the way the other ETFs are structured. The authorized participant has a profit motive to actually try to play the arbitrage side. So you've seen PSLV go to some pretty wild premiums and discounts to NAV in times of volatility. Not to say that's good or bad, because everything's going to do that, but it's just something to be considerate of, especially if you start to see more volatility come into the market. And because of all those shares being created and the incentive to do more at the market offering shares, I don't think you're going to see that fund trade at a premium unless we have some dire need for everyone wanting to actually own the metal. But if that's the case, it may be worthwhile. Well, then you have the investors have the opportunity to do arbitrage as well with taking delivery of the fund. So
Happy, was there anything that Bob was saying that you disagree with or anything?
No, I mean, he's right on how the offerings work and that they are dilutive. I think it's more just like, let's look at the actual impact of that dilution over time. And I think SRS Rocco posted the chart of this that kind of got this going again. But since inception, PSLV compared to just the price of silver has declined roughly 12%, including management fee and dilution. And when it was at inception, it had like 10 million ounces in it. And now it has 160 plus million ounces. So it's grown 16x. You've paid 50, 60 basis points in management fees annually since then, if you were one of the original owners. And then as the fund has 16 times its size, maybe half that 12%, so 6% of that was the dilution effect. So it is there, it's real. As the fund grows, there will be more dilution, but it's not even possible for it to grow 16 times from here. So I just think the impact of the dilution is relatively minor. I think there was a flashpoint when it grew from 50 million to roughly where it is now, that if you were holding in 2020 for the next year and a half, you bore the brunt of the dilution because that's when it really hit its big growth phase. And even bearing that brunt of dilution, you paid 250 basis points over the course of 12 months, including the management fee, which is terrible for an ETF. I'll admit that. But physical at the time was going for 20 to 30% premiums or even more. So you're still coming out ahead compared to buying physical. Advantage that it's not something that's in your control. But I think the impact of it financially is quite overblown in terms of people criticizing PSLV for having that impact. And like I said earlier, if you're planning to hold metal for 10 plus years, pass it down to your grandkids, just hold it permanently, almost permanently, as say like an insurance position, like you were saying earlier. Highly advocate for physical. Over time, you will come out ahead because you're not getting charged an annual management fee or the basis point per 1% of expansion of PSLV on the dilution. So it's really just about time frame. It's about where premiums are at. To what Bob was saying in terms of premium discount on PSLV, you can't really look at pre-2016 when, I think originally it spiked up to like 38% premium and then went to a discount. Like it used to be a lot crazier in that respect before they had their at the market offering, this thing that actually creates the dilution. Because if the fund traded at a premium, they weren't issuing more shares and buying more silver. Today, if the fund trades at a premium, they issue shares until that premium goes away and use the proceeds to purchase more silver. From what we've seen, the premium typically has a cap around 5%, and the discount has a floor as low as 8 to 10%, but that's really where the arbitrage starts to make sense. PSLV doesn't make it cheap to arbitrage, so it's around 7 to 8% where the arbitrage starts becoming profitable. But on average, it trades at about a 3% discount over time. So you will get variability there. And I guess to be fair, you'll also get variability in physical premiums to the point where dealers in the past have bought below spot on certain products, and currently they're buying far above spot on certain products. So when you're buying physical, you're also taking the risk of premium volatility on your specific product as well, rather than just more of a direct bet on the commodity that is silver. So it really comes down to the individual investor, what their goals are, how long they're going to hold, I think, for this decision.
Well put, Happy. Bob, do you have something to add there?
Yeah, I think, just not to belabor the PSLV thing, I think the ultimate objective is looking at from the client's perspective. When you're buying physical metals, you're trying to minimize the friction costs, whether it's transaction, whether premiums on products, the spreads on those products, the tax consequences of getting into any structured vehicle and then going through the route of taking delivery. And yes, you can get access to these metals, but there's more to it than simply just saying, hey, this one's better than that. And I think Happy makes some very good points of PSLV. It's just that there are expenses that are maybe not that are tertiary to what normally people may not be aware of. So, and that's one of the reasons why, again, I fall back. My default is physical metals, and just try to get it as cheap as possible to try and reduce, get good brands, that type of thing, but try to get metal at the cheapest premium. You're measuring your gain. It's easier to measure that gain because you don't have all these arbitrage and esoteric types of events that that could happen or may not happen or could happen, tax policy changes, financial market events, whatever that could impact the security. The metals just offer the opportunity. Hey, it's simple. I bought it at X. I can sell it at Y. That's my net profit or loss. And I don't have any of the counterparty risk. I think that's where I'm trying to come from, is try to explain to people. And I think maybe a good leadway into another topic. I don't know if Steve's back on or not.
He's trying to get back in here.
Okay, because I think what we're going to see going into next year is a real change in this industry. The way the price is moving, from what I see, the one thing I'm not a big proponent of is fear mongering and trying to overplay a situation for the benefit of selling product, for example. And you see a lot of that with promoters out there, and it's unfortunate because a lot of people end up paying a vast amount of premium or get the wrong product completely, or they get talked into something they shouldn't have been talked into, or they buy it for the wrong reason. Price goes against them, and then all of a sudden they add stress to their life, not actually, they don't add any value to their life. And so what I try to do is look at, again, the structure of the market, try to understand where this whole thing is moving and heading, and understanding the Basel III and all that, what was going to be the outcome of that, how that's going to affect the market longer term. I think you're seeing this unfold where the industry is going to start looking at the ability to meet demand or the ability to get the supply it needs is really going to become under question next year. And hopefully Steve will get on here. He can actually go through this whole. He can articulate some of this very, very well in terms of the mining data. But from a industry side point of view, the blank issue, a lot of it is a supply issue. It's ability just to make blanks, but it's more than that, because it's also, with this declining mine production that we've seen over the summer that I've been reporting on, and you have refiners that are taking metal out of the COMEX because they're having sourcing issues and shipping it back to Switzerland or sending it to India or wherever it may be. There is real demand out there, and as prices drop precipitously here, especially with silver, and Steve does a great job of talking about the primary silver producers and where their watermark is for making money and pulling the metal out of the ground and selling it. You're seeing mines actually starting to roll their forward contracts in the hopes of saying, hey, listen, let's see if the market can rebound. Or we're in a contango now, so now I can start selling a futures contract to try and squeak out a little bit extra gain, because to try and make up from the price drop that's happened in the spot market. And mining companies are starting to hold inventory back. Basically, depending on the contract that they have, there are hardship provisions that says, listen, I can't make money pulling this stuff out of the ground anymore, and it's not profitable for me to do it. And financing costs are going up. Everything's just chipping away at a miner, and obviously you see it with the mining stock prices. Their industry has become very difficult to make money in because of the rising costs of fuel and labor, and getting parts for their machinery, and it's just become a different environment for them. This is something that may not impact this year because we're pretty much near the end of the year, but going into next year, especially with silver being a big metal that's a big byproduct, most of it's a byproduct of other mining, copper and zinc and so forth, that can impact the next year's production or supply to a degree where, hey, listen, industry is going to need it no matter what. It's the question is, will the investor side get it? And that's where I think that's why you're seeing a lot of metal leaving London and the COMEX, as I think you have players that are trying to lock in sourcing of the metal now with the anticipation that next year it's going to be a totally different event. It's going to be very opposite, I think, for the industry, what it was the last couple of years, meaning the costs are going to go up for the product. You're going to have legitimate premiums of why it should be at X, not just simply because a retail dealer wants to mark it up $4 an ounce on top of what its costs are from the wholesaler, and a wholesaler marks it up $4 an ounce above what his costs are. I think you're going to have a much more dynamic market where, hey, these products are rising in costs, and it's going to impact the consumer much greater, and it's going to be more difficult for retailers, I think, to get product. That's one of the things that could be a big issue. And so,
just to interrupt you for a second, is that why you tweeted earlier that we could see a force majeure here? Is that when basically these producers or refineries can't get the metal to satisfy the market that they're needing?
Yeah, when you have a backwardation event, it affects, mines get affected in different ways, whether it's their capitalization costs or the way they hedge their production. Typically, if they sell forward, they're selling usually at a higher price than they are than at today's spot price. That's contango. But what's been happening is that contango is almost evaporated. I mean, it's now allowing the miner to maybe get a benefit of selling production forward 3, 4, and 5 months out, or 6 months out, whatever it may be. And so they're not gaining anything off that. They're not getting any type of extra cash, I guess you could say, to supplement their cost of production. With the issues, and I see Steve's back, and he can go through the numbers on the supply destruction that he's seen and the problems that we're seeing, especially with energy having a huge impact, not only on the mining side, but energy having a huge impact on the refining side, because you're seeing platinum issues develop, where it's getting more difficult to make the type of products, especially over in Europe, because of the energy crunch that you're seeing ongoing with natural gas and so forth. These are all effects that are we may as a precious metal investor say, listen, we're buying the metals for the protection of future inflation or future instability. But what we may not be realizing is it's coming, and yes, the paper price doesn't recognize it right now, but that's meaningless to a physical metal owner because we're looking this thing out, the next 2 to 4 years, not the next 2 to 4 months. I mean, for us, it's the whole reason to own physical is you don't have an expiration to this product. You don't have to worry about whether the thing trades at a discount or premium. You just have to worry about, hey, is my directional bet correct? And based on all the analysis, that I do, whether it be because of high debts or political instability or social instability, tax policy, those are things that the physical guy is going to buy the metals for, not necessarily, the day-to-day price action.
Happy you have your hand up.
Oh yeah, I was going to say, I guess for not having to worry about trading at a premium or discount on physical, you'd have to be talking about the 1,000-ounce bars rather than, say, all the other smaller products that their premiums vary quite dramatically over time. Are you talking about the 1,000-ounce bars, Bob?
It may be any product. The 1,000-ounce bar is the problem that we're going to run into is, they may be in demand. They're not going to carry a silver eagle premium. They never will. It's just the nature of the product. But for a refiner to ultimately, if they have to start sourcing and start paying up for these bars, that's going to be a cost that's going to reverberate all the way through whatever the end product may be. If it's going to be made into 10-ounce bars or 1-ounce rounds or ultimately pressed into silver eagles, for example, those are all factors that are going to impact. They originate from the 1,000-ounce bar if the 1,000-ounce bar becomes in short supply. And I'm telling you, with the COMEX continually draining, and I've been saying this ever since we were at 150 million ounces, I said the only way now is down. If India continues its demand, if you see other countries, with their currencies falling like a rock, continuing to buy, this isn't a U.S.-centric story like it was in 1980. This is a global event. And then at some point, when it does come to the U.S. and ultimately, our economy gets whacked and the Fed says, we can't take any more, no moss, and they start their yield curve control, you're going to have a melt up of all melt ups. Not to say the premiums may jump, the price may go up, but you're going to have people coming onto the market and selling product at some point. There will be a relief valve, but it's the price. It's what price do people want to start selling at, and that's where right now nobody's selling, or very few people are selling, and that's why premiums are so high, because the only product availability is mainly more from people that are from the mints and refiners that are making the stuff. But once, and I should say also, the borrow against your gold programs and that type of thing, you are seeing a lot of pressure in on that side of the business as well, especially with interest rates rising. That has also caused a little bit of the unwind in that sector. So again, and that adds a complexity of understanding your counterparty. If you're storing metals at a depository that runs one of these programs, you want to understand the ramifications and the strength of that business and how that could impact your holdings just as a going concern risk. But those are all side factors on top of obviously what we saw with First State Depository getting charged with fraud. There's other instances that may be beyond your control, even if you have a trusted depository. There may be a counterparty that may have traded with that gold dealer business that goes under, and then that impacts the gold dealer. So there's a lot of nuances that start to build from this. But the baseline is mainly looking forward to next year and trying to understand that most of the industry is based on a model of transaction business. If the metal becomes harder to get and premiums rise, not only for the consumer, but they rise legitimately for the wholesaler, where it starts costing them more money for this product, and they don't have the pricing power, let's say, to raise the price like they do to that fat margin that they have currently, you're going to see, I think, some of the second and third tier gold dealers start to run into some serious problems. Maybe the primary gold dealers will do okay because they may have the order flow and volume to manage their business, but it will start impacting the industry.
Perfect. Steve, did you want to jump in here and talk about the supply shortfalls that you were looking at?
Yeah, Tom, can you hear me now?
Yeah, sounds better.
Okay, again, I apologize having, if we think technical problems are bad now. Yeah, I think, we're seeing some interesting problems with supply, and what is the silver market? It's supply and demand. That's what it is right now. That's the determining price factor. And the underlying price factor is the cost of production. And so I know people disagree with me, but I don't care what product you buy in this world, whether it's from China or Australia, Asia, or the United States. What that price is set up on is the cost to produce that price, what it takes to get it to the store, what the store needs to charge to keep its lights on, pay its employees. So by the time you purchase that thing, it's the margin, it's all the cost. And so it's the same thing with silver and gold. So I've been saying this quite a while, that we seem to be getting to a low, even though we're fluctuating here, because we're at the cost of production for silver, which is probably a little bit below 20 now with the lower oil price. And so we've been seeing some big problems with supply coming from Peru. And I knew there was going to be supply issues from Peru because Buenaventura is one of the largest silver producers. There's also Hochschild in Peru. And Buenaventura closed the Uchuchaqua mine, which is hard to pronounce that mine, but it was one of the largest producers. They shut it down at the end of 2021. Why? Because they were having issues with poor mine economics. So they shut the mine down. They've been doing some drilling. There isn't really any plans to restart this mine until the fourth quarter of 2023. And so I looked at Buenaventura's economics, and I mean, they lost a good bit of money in the first half of 2022. So Peru, due to the rising costs now that's taking place in a lot of the third world countries, the mining of silver isn't really profitable, especially also in Hochschild. They barely broke even. And that was the first half. And so we've had lower prices now. And so when you look at what Peru is down 200 metric tons compared to last year. And here's an interesting one. Australia is down 168 metric tons. Australia is down 18%. Peru is only down 9%. And then Chile, which is the sixth largest producer of silver, it's down 62 metric tons. And Metals Focus said that we were going to see a supply increase this year. We were going to go from 823 million ounces. We were going to add 20. And most of their metal was going to come from Mexico. That's where the growth was. It was going to come from Chile. But no, we're actually seeing a decline in Chile, and Mexico has only increased 48 metric tons. That's like 1.5 million ounces. They were supposed to increase almost 16 million ounces. And this is as of July. So when you put it all together, simply put, the top miners, and I'm not including China because we don't know what their data is, the supply is down about 11 million ounces already. And the only place there's a little bit of growth is Poland, believe it or not, even though they've got the Russian-Ukraine war, high energy prices. They increased a little bit. And so there really isn't that much increase. So we're seeing supply declines.
Steve, if I could just ask you a real quick question on that. Does China not export any silver just the way they do gold?
Well, China exports some silver. We see that if you look at the Metals Focus, India is getting some silver from China. They still export silver. More They do export silver. They're not holding on to all their silver because they refine a lot of silver. So yeah, they use a lot of silver in their manufacturing, fabrication, but they are exporting some silver. So they produced about 105 million ounces. They increased a little bit last year, but overall, and then what's happening with Russia? I don't know how much silver is getting out. We do know Russia's natural gas and oil is being commingled, right? It's going to China, is getting some of the natural gas and some of the oil, and then they repackage it. They put a nice Chinese smile on the face of it, and it gets sent to Europe at 70% higher price. And so this is the kind of fun that's going on with Russian energy. It's redirected, and I think even though the LBMA and even the Swiss mints and the United States and the NATO or the European Union, they're no longer taking Russian silver 1,000 ounce bars and gold bars. But I believe somehow some of this is getting into the supply. But I still think a good percentage of it is not getting into the supply, which shows that this is part of the dynamics. And then, India just woke up this year. They're buying silver hand over fist. So these are kind of the dynamics that are taking place. And this is just the beginning. I see this continuing in the future. It's going to take a little bit of time, but I see huge demand coming and, unfortunately, less supply of silver from the global silver mining industry.
So, Steve, is there, of course, you're very focused on energy. Is that your... I mean, you and I are going to do a podcast next week about kind of the energy dynamics and how you see that. But is that the long and short of it, of why you see continuing shortfall of supply going forward here?
Yeah, my energy cliff scenario, which means we're going to see some severe drops in energy production, especially oil, going forward. And that's going to be very disruptive to the global economy and global supply chain. It is already. You've probably seen pictures. If you look at, they've got thousands, 10,000 Ford F-150s sitting in the Kentucky Speed Derby because they don't have semiconductors to put in there. So these are the beginning stages of what I call a breakdown in the global supply chain due to a peak and decline of energy production. And so I think that's going to be very problematic for the base metal miners going forward. And that's where 55% of silver comes. That's zinc, copper, and lead. And then 15% comes from gold. And so, yes, I think we're going to have problems with supply. But I've always mentioned this. If you're going to be investing in precious metals, you have to understand what's going on with energy. Because people say, well, I get into precious metals because of the debt. I'm investing into precious metals because of the collapse of the currency and the US dollar. And I'm going to get into the metals because of geopolitics or whatever. But really, all of those things that are taking place, we're seeing it throughout the world now. Problems with bonds, the UK gilts, that's all due to the energy. So we need to really focus on what's happening with energy because it's really impacting this highly leveraged financial system that's so bloated. And so when more market participants, and I think this is going to be some large institutions, wake up, and even large net worth investors, they're going to have to move into physical precious metals because it stores what our economy is based on, burning energy. And that's what metals store energy value. People say, oh, they store energy. No, they don't store energy. They store energy value. And that is the reason why they've been money for 2,500 years. Nothing's changed in 2,500 years. And so that's the reason why I'm very positive about owning the metals. And I'm not frustrated when I see what's happening, like right now, low silver prices, lower gold prices, because I know this is just one stage before we start moving up to higher prices due to the problems that are going to have with energy.
As the old saying goes, there's no cure for low prices like low prices, right?
Yeah, and again, why they shut down Uchucchacua mine was producing 5 million ounces of silver a year, 2020. Then it was 3.7. Then at the end, they just shut it down. Well, they shut it down because it wasn't really economic to produce the silver. They had to do more drilling, exploration. And so we are right now, and I always mention this, Tom, if you look at a chart of silver production going back to the ancient Roman Empire, and it shot up because they produced lots of silver because they cut down 1 billion trees to produce metals. I mean, that was a lot of wood fuel to make the charcoal to make the metals. And then it collapsed. But then over time, as the world spread and we cut down more trees, we made more charcoal, we produced more silver, especially the Spanish did. When they went to Mexico and South America. And then we started really see, it really goes exponential when oil came on the market. And so that's the reason why we've got all this silver. And it's due to the energy that allows us to really increase the silver production. Well, now that energy is getting ready to roll over. And so now it's very important to own the metals, because in the future, if we think the price of silver now compared to what it will be in the future, and I know that sounds like I'm being hype, but yeah, the market has not figured out the problems with energy yet, but it will.
Steve, you said that some of these large funds and institutions will start moving into the physical metals. At what point do you think they start waking up to that instead of just trading these paper representations of that? And is it possible that they're not able to get, or that impact gets muted when the markets crash and they don't have the ability to liquidate some of their positions?
Well, it's so funny. I just watched the Margin Call movie, and I highly recommend anybody watching that. I watched it again, and it's kind of a fictional account of what happened with the mortgage-backed security meltdown. And I believe the bank was Goldman Sachs. And so Jeremy Irons, who's the CEO, he knows when the music stops, and it's time to get out before the fat lady sings. And so what's going to happen in the opposite way is we're seeing the complex breakdown right now, because look at the bond market. I mean, the bond market, the returns on bonds just really continue to decline. And then we're seeing these huge volatility. That is going to disrupt. And now with the US Treasury, I'm doing a new report on the treasuries. We were supposed to get to the U.S. debt ceiling. It was 31.4 trillion, a little less than that. We were supposed to get there sometime in the first quarter. We're going to get there probably November, December. We're not even going to make it till next year. And now the U.S. government is going to have to issue more treasuries. And so it's a real mess. So these dynamics can really start to unravel quickly. And so I think what makes sense to me, either a few institutions or a few large net worth investors, and we already heard about one very wealthy woman buying a whole bunch of silver bullion. This is just the beginning. And so wherever they buy the metal, this is because we're going to have so many disruptions with these assets starting to unravel. Yes, there's going to be a lot of destruction in these asset values, but there's 500 trillion of this stuff floating around there. So, just a few trillion getting out of there and moving into metals, we're talking much bigger prices. I mean, you could buy all the silver in the world for how much? $60 billion. 60 billion, and you can get most of the silver, maybe 100 billion. Now, what happens when 400 billion, 500 billion try to move into the silver market? And that's still nothing. So I think this is the dynamic that I'm talking about. And we haven't got there yet, but I think as we start to see more explosions in the energy market, more smart institutions and large net worth investors are going to start waking up, just like this woman did who bought a lot of bullion. It's in the beginning stages.
In support of what Steve is saying there, folks, that all we need is a couple of quarters, maybe a half a year, 3/4 of a year of some positive, I think they call it positive alpha, where some of these institutional managers start watching and they start seeing some outperformance in silver or gold, those kind of equities. And the equities have been really beaten down really hard. So if we start seeing 1/4, 2/4, 3/4, a year of positive alpha, I think you'll see some pretty good weighting coming in from some of these institutions. And that might be $25, $27, $29 type silver basis, front month futures, if you will. And everybody in the room, they've got a chance to front run all those institutions if they start buying, shortly.
Jim, you're right. And one more thing, and maybe some other speakers can add to this. The problem we're seeing now is the confidence of collateral, right? And what is the collateral? It's the treasuries. The U.S. Treasury tends to be the number one collateral that everyone wants. Well, it's really not a good quality store of value. Maybe a bill is some of these very short dated ones where you can get it in and out in a month because the world isn't going to blow up in a month. But some of these longer dated bonds, the 10, the 20, to 30-year bond, the issue is when the markets really start to break down due to the over leveragedness and how energy is going to disrupt this, as it's already starting. We're going to go from people in the world moving into treasuries or the dollar. They're going to have to get real collateral. And the real collateral won't be real estate. The real collateral is going to be the 2,500 years of money, which is physical metals, which used to be the real collateral years ago. We moved away from gold and silver being the basis of our economy because we had all this wonderful energy we brought on. So we could drum up and make up all this imaginary collateral. And so there's all this collateral out there it's an asset, but it's really a liability masquerading as an asset. And it isn't an asset, and it really isn't collateral. And so I think that is another dynamic why I see institutions being forced in time, move into metals, because they're really going to have to acquire real collateral as we head over this energy cliff.
Yeah, well, one thing I would mention also is that the reason why I'm big into physical is the idea of being able even to get metal from a fund or a program that may promise the ability to get the metals today, but if they have a run on their system, so to speak, it would be in their best interest to cap the ability to get metals or to be able to deliver metals. Otherwise, the program would go out of business. And you see that potentially, with the COMEX, with some of these inventory levels getting down to the levels that they're at right now, there may be a point at which, when that metal gets to a certain level, that they start making it more difficult to basically take delivery, or make it more expensive to take delivery. And those are great points, because in 1980 you had, the institutions had about 5% of their net worth in gold. Today it's what, 0.5%. There's just so much. There's everyone is predicated or basically in the same ship at this point. And you're right, the collateral situation, it's not necessarily whether the U.S. government's going to default. It's the value of that collateral as interest rates are rising. The volatility of that, and then you factor the leverage that a lot of institutions put on, especially with these structured notes. It makes the things even that more unstable.
Also, Bob, we've seen some of these central banks, some foreign countries that aren't really in love with the United States. They've been liquidating some of their treasuries that they hold in reserves. But what they're doing with some of that money, some of these central banks are actually buying gold. I believe China and the former former Soviet Union and India and some other European central banks may have been buying some gold. So there's a pair trade right there, sell paper and buy physical.
Yeah, I think the advantage on the institutional level is that gold acts as a neutral reserve asset. So it doesn't require, it works with any country's currency basically. And that's what sort of makes it kind of unique. And of course, that's not really the benefit of the dollar or the euro, that as they see gold gaining value against that, or their currency dropping in value against the gold, I should say, it's a detriment, and it lowers confidence in its own currency. So there obviously has been a big push over the years to sort of cap or demonize the metals for the purpose of basically making the treasury look like the greatest asset in the world.
What do you mean it's not, Bob?
Well, I guess at 30 trillion, I guess everybody's all in at this point. So,
Patrick, I know you were saying you wanted to share some stuff with us if you could.
Hey guys. Yeah, well, you guys know me, like I do the charts, and the biggest theme right now is it's all about capital flows. So no matter like what reason, all the narratives, all the stories, everything, because you could have a situation that's happening right now. Oh, let's say we're running out of gold, running out of silver. You could have had that same story, but at the end of a 10-year bull run in precious metals, and the price would still go down. But what's happening right now is SPX going down, gold hanging in there. The ratio now, the flows going out of SPX are going out faster than they're going out of gold. And eventually I have some technical levels, but when gold's going to be about half of the value of the SPX, no matter what level it is, then that means the capital flows, or all those hedge fund managers, the math, for whatever reason, they're going to believe that hold on, something's happening. SPX broke down versus PPI, SPX broke down versus inflation, SPX is breaking down versus gold. The math for them, whatever calculation they do, they'll start looking elsewhere, starting buying gold, buying silver. And what I've seen is the charts of silver, uranium, the miners, gold, silver miners. If you overlay practically almost any of those charts, they look exactly like the gold divided by SPX ratio, practically. So capital flows are divided by the performance of gold versus SPX, and everything else in the complex depends on that. So that's pretty much what I'm looking at right now. And maybe 1 to 3 months, as the SPX, if it could really go into a bear market, not like a March 2020 type of bounce. We want a 2001 type of rollover, a 1969 type of rollover. And once that ball goes really down, then it's the spigots will be open for the precious metals complex. You buy the dips and all the narratives and stories to explain why that move is going up. They're going to be flying left and right, but essentially it's just the capital flows that will be entering the sector because of all the inflation that did damage to U.S. growth stocks.
Interesting point there, Pat. So as you say that we're going to get to, what did you say, half the value of the SPX?
Yeah, .05. So wherever the SPX is, so let's say SPX is at 3,400 and gold at 1,700. That's like the magic mark where that value of gold I'll have on the chart is going to look super bullish. Get a monthly close above .05. That's a breakout from a descending trend line that dates back from 2011-12 top all the way to today. It's above a horizontal breakout line. Like, it's go, 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 you know. This is the type of signal we got back in 2002, the same type of signal we got back in 1968, 69. You know, these are signals you get every generation, right? This is huge. So that's what I'm keeping an eye on. So
when or whereabouts are we now on that ratio?
How
far do we need to go?
We're .047, so we're .03 away from a breakout. Every day I've been posting like on the hourly chart. I'm having fun with that, just to see how it's progressing towards that .50. So there's probably gonna be some resistance at .50. There'll be a pull, like it's gonna bounce down, and then we'll see if we carve in a higher low. But look, gold right now is doing a run. It's doing a run to that breakout line. So it hasn't done that. The last time it did that run was from 2018 to 2020, and it brought gold $800 higher from the 2018 to 2020. In 2020, when we were all looking at $3,000 gold, if we'd taken a step back, I would have seen that descending trend line was morphing into existence. We were actually hitting resistance from that gold to SPX ratio. That's why everything halted back in 220. But right now, after 2 years, we went down, and now look, we have another shot at it. So it's like the hot girl at the bar, man. You don't get 2 shots at it there. It's time to score.
I think you've shared that analogy with me before there, Pat. Is that chart on your Twitter, and we could post it in the nest here?
Yeah, it's I put a whole bunch there. That's probably like the theme that's been going on my Twitter there since I spotted the gold to SPX ratio, its importance with like everything. Here, yeah. So yeah, take that and pop it in there, and so that's for me when I'm looking at really closely.
Excellent. That's interesting stuff, Pat. I appreciate you jumping in and sharing that with us.
My pleasure, Tom.
Bob or Steve, do you have anything to add to that? I'm just going to find the chart here and put it into the nest.
No, I think the charting of silver, I do believe technical analysis does provide us some insights of where these are going to move. And it really is based on the fundamentals too. And so that kind of drives the technicals. But I think one important thing I want to share has how much the silver market has changed since 2019. And I think people may not appreciate this, but most of the silver, I know I made a joke about this, that, everyone talks about the COMEX, and we hear all this analysis about the COMEX, and really the COMEX is becoming irrelevant. I believe in time it'll become less and less relevant. First of all, most of the silver is stored on the LBMA. And what's interesting, back in 2019, Tom, the LBMA had 1,150 million ounces of silver. And 2/3 of that was the other LBMA. Who knows who owns that? And only about 380 million ounces was for the ETFs. So twice as much as that was for the other LBMA. Who knows who owned that metal? But now it's switched, and no longer is there 1,150 million ounces in there. There's only about 870, 60 or something like that. And there's only 300 million ounces of other. And so most of the silver is in the ETFs now. And then if you look at the registered silver, everyone knows it's collapsed, right? But it's almost to a low like it was back in 2017. But the gold registered is still 2/3 of the level it was before the pandemic shutdown, because it shot up. It really shot up. But there's still a lot of gold in the registered gold category on the COMEX, and there's still a lot of gold on the LBMA. Little bit has come out. Where a lot of silver has come out is either registered and on the LBMA. I actually believe, even though metal can flow back in, I'm starting to, and I've talked to Bob about this, I think we're starting to get some strong hands now. Some of it's India, a lot of it's India. And so we're seeing the silver, unlike gold, is being removed from the exchanges for various reasons, but I think a good bit of that is going into stronger hands. And I see that continuing as we get more problems with the financial markets and energy.
Yeah, one other thing I'd probably mention too is Patrick makes a really good point with the S&P flows and via gold. You break down in the markets, you start breaking down below 3250 on the S&P. I think that's where the vaccine sort of announcement was. And if you start getting below 3,000 toward 2,500, at some point you're going to get a breakdown. You're going to start to see actual the risk of a banking crisis develop, because at that point, collateral is just getting absolutely hammered on all fronts, not just simply the bond market. I mean, we have obviously seen something that has perplexed a lot of people this year, is that bonds aren't a safe haven, and everything is basically intertwined because of the liquidity, because of that 15, 20 years of money printing that they've done. Everything has been inflated. The only way you can decipher between one asset or another at the end of the day is the counterparty. And that's, again, why the metals make a lot of sense. Commodities make a lot of sense. I think Luke Groman kind of talks about, the idea of, it's our, it used to be our dollar, your problem. Now these countries that have commodities say it's our commodity, your problem. You haven't seen that pricing power yet that, maybe countries are going to start having that, and that could affect mining production as well, which is something that we've always taken for granted, especially in politically, safe environments. But that's also an outlier where countries say, hey, listen, these commodities are just too valuable just to let go.
Yeah, and Bob, one more thing, and I mentioned this before, but it's good to repeat it. Even though we'll see a decline, and I say this, when we're heading to energy scarcity, things you own are going to lose value. Stocks, bonds, real estate, trucks, boats, car, all those things are going to lose value. Things you consume, food, energy, goods, they're going to inflate. And so, but we have to understand there is, and the number I found, it's over 40 trillion. It's about 40 trillion, but it could be higher, 50 trillion. I don't know it, but that is the number of the money supply in the world. It's about 40 or 50 trillion. And it's held in cash. It's held throughout the world. A lot of it's in the United States, but it's cash in different forms. It's the M2 money supply, M3 money supply. Well, that is not an asset. That's not a stock. That's not a real estate. That's not a bond. It's cash. Some of it could be in bonds, but the thing is, and this is what I think is going to be the problem. Back when you had the hyperinflation during the Weimar Germany, they said an ounce of silver, an ounce of gold could buy you a hotel. An ounce of gold could buy you a hotel. And I think the thing is, there's so much money supply sloshing around. When the market starts to realize they have to park that money somewhere and save its value because the value of the currency is starting really to decline, that's when you start to get, panic. And so that's when I start to see, forget about the other assets, all the hundreds of trillions of stocks, bonds, and real estate. Let's talk about the 40, 50 trillion of money supply trying to find a home to park it somewhere, because look at the prices of food going up. I mean, Pepsi said its food products went up 17%. Well, as the currencies really start to collapse, people are going to want to park that money somewhere, and you can only buy so many goods. So where are you going to park that money to save its value? You park it into the metals, because the bonds really aren't doing well right now. So I think I wanted to add that dynamic that I think is really underappreciated in the market.
Just a little bit of the last 30 or 40 days of price history here on the silver. We made the low September 1st, just a few cents under 1750. We rallied last week to a high of about 21.40. So almost a $4 move, almost a full $4 move upside. And we've taken that high away by about half. We dropped about $2.50 under $19 today. And we just opened for the night. We're trading 19.01 basis December silver. So if my point in all this is that if that September 1st is the low, that 1750, 1740 area, if that is the low, we have, by definition, it's all up from here. So that's kind of what my bias is. My bias is get back to 21 and then 23 and then review it again after $25.
Jim, one additional note. I do agree. I've been talking about silver hitting the lows. And do you know why silver and gold fell to their lows in 2008? Because this, I'll just repeat if people who don't, because oil went from 145 down to 30. And then why did the silver and gold go to their lows in 2016? because the price of oil had fallen from 100 in 2013-14 down to 30 in 2016. So there's some method to the madness. Now we've got the price, oil had fallen to the 70s. Now it's back up, it went back up to 90 due to Saudi Arabia and OPEC saying, well, we just may cut 2 million barrels. And so the one caveat, if we have to look at the oil price, I think the oil price is going to go higher, but if there are dynamics that play out in the market and the oil price falls down to 70, 60, 65, 60, we have to realize that will bring the metal prices lower. And so that we have to look at, and that's what it's done that before. I'm not saying it's a guarantee. So we need to keep an eye on what happens with the oil price. But if we see higher oil prices, especially when the White House, Biden stops selling SPR oil and OPEC cuts production, you're going to have a 2 to 3 million barrel a day swing in supply. It's going to be gone if that all happens. So we need to look at that to see how that's going to impact the oil price and the metals prices.
Also, Steve, in support of what your premise is there, we're heading into winter in the Northern Hemisphere here and in Europe, and homes, cars, industry, they use more heating oil by definition because it's wintertime. They got to keep their places of business, at a reasonable temperature. Maybe it's 70 degrees, 72 degrees, something like that. So winter between, let's say, mid-October and mid-March, winter uses more crude oil.
Yeah, and one last thing. Sorry, Tom. I don't mean to go on here, but the Fed is getting ready to do their next meeting and possible interest rate hike. Well, in looking at, they don't have it out today, but it's going to be out tomorrow. The U.S. gasoline and diesel inventories are below their 5-year averages, and they continue to decline. They're not building like they should be. And so what that means to me, Americans are still happy paying a little bit more, and they're just driving around. And so I do think we're going to see even higher interest rates because we're not killing demand enough to get prices lower. And so, again, I find this very interesting that we're not seeing a build in U.S. gasoline and oil and diesel, especially diesel. And they use oil for heating. We're seeing that it should be 150 million barrels right now. That's it's at 111. We're almost 40 million barrels less than where it should be. And the United States is producing the most oil in the world. And so I think this is a very important dynamic. Why I think, unfortunately, the central banks are likely, the Fed is still going to continue raising rates because they don't see demand falling.
Steve, maybe if you could explain that relationship between the lows in the metals and the lows in oil at the same time. Like that might be counterintuitive, let's say, for people that are looking at it from the perspective of miners' costs going down because of their energy costs to get it out of the ground.
Tom, good question. And there are times, that is not the guaranteed absolute rule, but when we look at the cost of production, that tends to be the rule. When we saw one exception during the pandemic shutdown, right? Because for a brief period of time, oil was negative. It had fallen because there was such a glut of oil. They had shut the global economy down. There's no place to put oil. Traders didn't want oil. And so oil went negative. Well, when the oil prices fell, guess what? And not only the oil prices, the natural gas prices fell, the cost to produce silver and gold really declined in 2020. At the same time, the prices shot up. And that's why the gold and silver miners, their stocks shot up so much, because they were making record profits due to the collapse of energy prices and the huge increase in the fear factor of the market getting into gold and silver. And so there are times where that goes in the opposite direction. But it tends to function that way. And this also happened in the 1970s, because I've said this a few times. The reason why we had the explosion in the price of gold and silver in the 70s was because we had an explosion in the price of oil. it was $1.80 a barrel, and it went to $36 by 1980. And so the cost to produce gold and silver surged. So the price had to go up with the price of oil. And so I think this is the dynamic that is overlooked in the market. But going forward, Tom, I don't look at the cost of production being the reason to own the metals. I look at the problems we're going to have with energy destroying collateral and a lot of asset values, waking up the mass psychology of institutions and investors that they need to protect wealth, because we're going into a world from building wealth to protecting it. And you really can't protect it in these assets that are based upon burning more energy every year. So I just wanted to add that too.
Excellent, Steve. I appreciate that. We'll open it up for some questions here from the audience if anybody has any. Bob, was there anything else that you wanted to go over? Maybe clarifying that idea of the backwardation or the force majeure at all?
Well, one of the things that I kind of watch for on backwardation, and you watch the EFPs and so forth, is seeing as we've gone into contango, it's been basically more short covering by funds. And then when it gets into contango, you start to see them starting to pressure the markets, and you see that contango start moving back in the backwardation. It's almost like a ping pong game going back and forth between backwardation and contango. And I think a lot of that is more on the financial side, on the paper side, just having, the funds having their effect on the futures markets and the paper markets in general. One thing we were going to mention that, this massive drawdown in 10 million shares or so covered shorts on SLV a couple of weeks ago. Some of that, you see some of that pressure coming off of that borrowing rate. Because the problem we run into as individuals, as investors, we're on the outside looking in, so to speak, is that you don't get the quality of information that maybe a Goldman Sachs gets right at their fingertips in terms of the speed and depth of the information. So you don't, some of the stuff you get on a delay basis, and just whether it be because of reporting requirements or just regulatory delays, whatever it may be. So you try to look at other things that give you sort of the cookie crumbs of where the markets are or what they're doing, and so you try to tack on that borrowing fee for shorting. I mean, you start to look at other types of things, delivery fails, so forth. Other things that'll give you some sort of hint of, okay, did we kind of pass the point of all this chaos, or is it still coming, or is there still a lot of volatility to come, or are players still positioning themselves trying to push the market down, that type of thing. So I found it interesting that the backwardation issue has probably been the contango. The one thing that I've kind of pointed to that's been pretty consistent in terms of market direction after that squeeze that we just had. Everything went to contango across the board, and then then the selling pressure kind of kicked in, and that short covering kind of blew itself out. But that doesn't mean that we're just stuck in a trade or a wide trading range. We're really dependent, obviously, of the inflation numbers tomorrow, which are going to be probably add a lot of volatility to the market. Plus, you have the Bank of England with their sort of this is your 3 days to get your affairs in order type of thing. I mean, and you're walking into a weekend, so you're watching for the market to potentially rally in the morning. And then if it starts to fail after that rally and closes at the lows, that could set up for some serious pain going into Monday. But those are, obviously we take one economic number at a time.
Thanks, Bob. All right. Anybody else have questions?
So, I watch a lot of videos. I watch you guys all the time. I watch all kinds of stuff on silver on YouTube. But anyway, I'm seeing videos where China are buying a lot of the gold, but they're also advising their employees. So they're telling their employees, store up gold, store up food, and our country keeps it quiet. I mean, they're preparing their people for something that's coming down the road, and we can't even voice our opinion because everything's censored. I just think like it's a planned collapse of the United States, and we're going to be in bad trouble when this thing collapses, and nobody has anything left because our pensions are going to be wiped out, and we're going to all be broke and poor. It's scary times.
Well, if you don't mind, I'll take that one. I have a little bit of a different. Now, I'm not against that. The world is facing difficult times. That's true. The devil is in the details. However, I have been one of the proponents that think if there's going to be a disruptions in the global economy, in these different global economies and regions, I can tell you China is going to be way up there. Even though they may be hoarding some food today for tomorrow or for the winter, you got to do all that again next year. And China, if you look at their trajectory of how much energy they're burning and how big that they have grown their economy, and I've mentioned this a few times, but if you're new, it's good to hear it. What the U.S. used in cement production in 100 years, China did it in 3. So you look at the United States and how many roads and highways and parking lots that we've done, buildings, bridges, what we have done in cement, produced cement, laid cement, we did that in 100 years. China did it in 3. So it just goes to show you how huge. I call China is like Walt Disney World on steroids. So I'm not one that believes China is they're going to be in serious trouble. Actually, I think they're going to be in much worse trouble because they took hundreds of millions of Chinese from the country and they brought them to the city. And now they have to continue keeping them employed. So what I'm saying, though, there's going to be issues for everybody. But I think that the collapse of the Chinese economy is going to be worse than people realize. It's still going to take time, but yes, I see big problems with the Chinese economy.
But a lot of the food that's being produced in the United States now is going to China, and they're being and China's buying a lot of our farmland. I think eventually this is going to catch up, and it's going to hurt us, and we're going to be short of food and commodities.
I think that's coming sooner than later. You look at the fertilizer shortages and rationing. There's all kinds of conspiracy theories out there about the fires in all of the food processing plants. I mean, it's obvious that there is something going on here with that will dramatically affect food supply. I do agree with that.
And last point I want to make, I just closed my PayPal account yesterday. I don't like the fact that they don't allow free speech.
Oh no! Didn't you see they rescinded that? It's no big deal now.
My account is closed. It doesn't matter. Their thoughts are, if they have that opinion, I'm no longer with them.
Well, and interestingly, I discussed this with somebody else earlier today, and it seems like more people are kind of waking up to this. There seem to be more people that are making that choice and kind of waking up to all of these facts. And it's almost like the free market is re-exerting its will on choosing companies and services that don't go against people's freedoms and rights to say what they need to say.
And my sister had the jab, and she's having strokes, but I'm not allowed to say that because I'll be censored for saying that. It's a sad time. And it's just heartbreaking that people are suffering from something that was forced on them.
Well, and I think that I say it like this. I've had a couple guests say it this way. We're obviously kind of going off the rails here a little bit, but we all need to kind of lead by example and be the change that we want to see in the world. Respectfully disagree with others if they have a different opinion, but stand up for what you believe in and what you think is right. And don't have the courage to be able to say that and not back down.
I really appreciate it. I really appreciate you giving me the time to speak today. Thank you so much.
Not a problem, y'all. Enzo, did you have something to say?
Okay, I'm from the UK. Ethically I'm from India, and I'm just worried like everybody else. Just how to preserve one's wealth and what to do about it. And for the last 10 years, I've been into the precious metals, just buying the physical. Just last couple of years, I've gone into the mining stocks. quite heavily actually. But listening to all this about energy and how this can collapse, the market, and when it comes to push and shove, when you need your capital, it's better to have it in your hand than actually into banks, in banks or broker. My question is, if you got money in most of your money in brokerage accounts, is it still at risk like a bank? Number one. And number two, just one more question. I've inherited a bit of land, agricultural land, back home I call Bangladesh. And I was thinking, a while back, because a lot of UK Asian people, they don't go back home, and they've settled here, and they're basically selling all their land, and just buying houses, or they just made up their mind they're just going to live here. With the kids, they don't speak the language anymore. They're cut off with the culture, so they see themselves as fully British, and they have no connections. So the parents have thought that for the future of the kids, we have to liquidate everything over there and bring it. So my question is, when the price of things go up, would land keep its value, or would it lose its value in a situation where we have this final meltdown? That's my question. Sorry for being vague or anything like that, but yeah, that's my question. Thank you if anybody can.
I could probably talk about the on the real estate side. Land is going to be something that's more of a utility at some point, and whether it can be, you can generate income from it, or if it's going to be something more for just residential or business purposes. I can speak about the United States. Not sure about India, but basically in the United States, couple of things you'd have to have some considerations of is interest rates play a big factor with regard to real estate, because most of the transactions that are done here are financed, and as rates go up, the cost to acquire the property goes up, that monthly payment goes up, so therefore the relief valve is lower prices, and that's something to consider when you're coming off of a so-called everything bubble, where everything has basically gone up in value over the last 20 years. And now you have potentially where the bond market has made a 40-year, it's been in a bull market for 40 years and it's topped. If that's the case, these are the fixed income markets are more of a generational type of move. So you may be looking longer term out with higher rates to come in the future, and that's going to be a headwind for real estate, unless it's location specific. If it's fertile farmland, something like that, you can actually run a business off of it. Then obviously that takes on into account a lot different value. And then on the brokerage side, here in the United States, we have something called SIPC, Securities Investor Protection Corporation. It's kind of like FDIC insurance, where investors are protected on the value of their account to a certain dollar amount. But the relationship you have with your broker dealer versus your bank is a little bit different. With a bank, when you give them money, it's basically you're an unsecured creditor. With the brokerage account, depending on if you hold the positions on margin or you hold them in cash, and the types of investments you have, it's geared to try and protect the investors' positions, I guess you could say, because the broker company doesn't operate like a bank. They don't take your capital and then lend it out or try and make a spread off of it. So I don't know if that may help a little bit or provide a little bit more color for you.
Honestly, Bob, like I said, I love hearing what you are speaking. That is honestly something great.
Yeah, well, I appreciate it. Thank you.
Okay, guys, we have time for a couple more questions. But yeah, it's an interesting thing to try and think about. Is if your money is supposed to be safer in a brokerage account than a bank, but that in some ways that chain of custody, how do you get your money back out of a brokerage account without going through a bank as some type of intermediary. If we have another situation like we had in Canada last year, that seems to be a tough problem to get around. Bob, have you put any thought into that?
Yeah, well, I was just going to mention, because you bring up a really good point with the on and off ramp of assets to relative to the banking system. And I think, a lot of people that buy precious metals may not think about the exit strategy when they initially buy the metals. They're more worried about just obtaining the metals and procuring them and safeguarding them. But I think it's important that if you do own precious metals, and let's just say you do buy it from, a dealer or a program or a structured program, understand that program, understand what the costs are to get back out of the position. Because a lot of programs are structured out there to be a closed loop type of program where basically you can't just simply store your metals at a depository and then call 15 different dealers and get the best price. A lot of these programs are designed to be a captive type of program where you have to sell back through them. So that adds complexity, at least with regard to the precious metals, because you want to know the counterparty or the dealer strength, what kind of businesses they're in, how they're diversified. And those are all questions to ask. Again, reading the contracts, understanding, the relationship, who you're actually signing that contract with, if it's a depository, if it's with the gold dealer itself. And then, of course, if you're dealing with overseas types of programs, understanding, if you're, here in the U.S., if you store your metals outside the U.S., you want to understand if it's held directly or if it's held more in a sort of a financial type of structure where you're dealing with the gold dealer. They have the ability to go into your account and take the metal out to procure or to settle a transaction. That may be considered more of a foreign financial account than it is metals held directly. So you want to understand that type of structure as well if you're holding metals outside your country where you may have reporting requirements. So just a few things to consider, at least when you're trying to diversify, and then also trying to relate, okay, when I do start selling my metals, how do I get cash per se? We may not think of, if silver goes to $60 an ounce, we may say, my God, the last thing I want to do is go back in the cash. It's worthless. But you may want to go into cash as a trade to basically turn that into something else. You're just moving money around and looking for the next form or next undervalued asset. So that's just something to consider.
Excellent, Bob. Steve, do you have anything to add before we maybe wrap up here?
Not really. We've touched on everything. I think, and I don't mean, I tend to be the party pooper because of what I look at the energy and the energy is a driver. So I think where and when I talk about these problems with energy, disruptions, collapse, we hear these words, these adjectives. A lot of people, they're like running to the exits. It's going to take decades for these things to happen, and it's going to be very disruptive. And so I just want people to realize where we're headed is a very different situation than where we've come from, because we don't have to worry about energy. You turn switches on, you do things. But what we're seeing in Europe, they're having to get wood to keep themselves warm this year. And now it's hard to get wood. The price of wood has skyrocketed. And so people think, well, gosh, thank God I'm not in Europe. Those poor Europeans. Well, this is going to happen in other parts of the world, and it's going to happen in the United States. There's 20 million Americans that are behind on their electric bill. And so I think people just need to understand it's important to be into physical metals due to these issues, but we also need to understand we're heading into a world of energy scarcity that we've really never been before, and it's going to change the world as we know it. So we just need to be prepared mentally and physically the best way we can. I think that's the way I conclude it the best.
Well put, Steve. And I think, thankfully, a lot of our listeners and obviously our speakers are fairly clued into this stuff. And I've said it before, and I guess I'll say it again, is that I don't think that we're going to be worse off for understanding or at least learning about some of this, and hopefully we can do something about it. If anything else, just lessen your anxiety around it. If you can try and understand it, try and understand the way the world is going, and maybe feel a bit more prepared for it. Bob and Steve, I really want to thank you guys for your time, and thanks to everyone for tuning in. I appreciate the numbers, and hopefully we'll have more interesting stuff coming out for you guys. Thanks so much.
Appreciate it. Thank you.
Thanks, Bob, and thanks all the listeners and speakers.
You too, Steve.
Thanks, Tom.
Thanks, guys.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.